No, nothing really surprising here. What we knew was that the RBA had a new piece of information in the form of the first quarter GDP print, and it ran at a little bit above what the market was expecting, what the RBA had in mind, and it really provided a bit of confirmation for their own forecasts that growth would remain a bit above 3%. So they've articulated that quite clearly in today's statement, saying actually they're still forecasting that growth will be above 3% this year and running into next year. So the growth story is very positive. But as they've repeated in this statement, and they've been repeating for months now, inflation is still expected to be low. The rise they're expecting to see in wages growth and inflation is expected to be very gradual. So it's very clear that the RBA is very firmly on hold at present.
Paul, do you think that this means that they're basically going to continue with this outlook of a sort of glass half full mentality?
Well, I think this is very glass half full. That would be my reading of the statement that we got from them today. It says that the growth is picking up, and they're expecting growth to remain above trend through this year and into next year. Consistent with that, they've got in mind the unemployment rate will fall, but only gradually, and that will gradually put a bit of upward pressure on wages growth. They pointed out that timely indicators of the labour market, like the vacancy measures, which we got an update for last week, are sitting at very high levels. They're clearly of the view that the momentum in growth is going to continue, and that is going to gradually absorb spare capacity out of the economy, and that eventually, at some point in time, that will start to put some upward pressure on wages growth and inflation. They're clearly not articulating any sort of sense of timing, but you get the sense from this statement that they're still of the view, although they did not specifically state it, that the next move is probably likely to be up for the RBA, which is consistent with market pricing at present.
And Paul, you mentioned the wage growth issue here in the statement. The RBA saying just now that wage growth does remain low and likely to continue for a while. You talk about this idea that with stronger growth should come an uptick in that wage growth. But what if it doesn't? Is that why we are hearing some calls, I know it's not your view, that we could in fact see a cut before we get a hike?
Yeah, I think that's part of it, but I think the bigger concern is a global one. I think if we were to see a global downturn come along at some point in time, for whatever reason, that would be the thing that would really have to happen, I think, to get them over the line for considering actually lowering interest rates. I think the governor of the RBA has made it very clear that he's got a very high hurdle for considering that the next move would be down. I think it would take a global shock for that to happen. I think the domestic economy is clearly showing enough momentum that eventually they'll get enough wages growth and inflation that the next move for the RBA will be up. Our own view is that won't happen until about the middle of next year. They'll be firmly on hold until then. And so it's very much consistent with the idea that the lift in wages growth and inflation will be gradual. But I don't think the next move is likely to be down, barring some sort of a negative shock from abroad.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.